Welcome back to our channel. Today we're diving into a topic that can be a real headache for C Corporation owners: the Accumulated Earnings Tax, or AET. This hidden tax can catch you off guard, and the consequences can be costly. But don't worry, by the end of this video, you'll know how to avoid these pitfalls and keep your business running smoothly. Let's get started. First, let's talk about the basics. The Tax Cuts and Jobs Act of 2017 brought many changes to corporate taxation. One of the most notable being the permanent 21% tax rate for C corporations. While this might seem like a great deal compared to the previous top rate of 35%, there's a catch: double taxation. When corporate profits are distributed to shareholders as dividends, they're taxed again at rates up to 23.8%. To avoid this double taxation, some business owners might think about retaining profits within the company. But hold on. This is where the Accumulated Earnings Tax, or AET, comes into play. If the IRS determines that your corporation is retaining earnings to avoid paying dividends, they can impose a 20% penalty on those retained earnings. So what triggers this penalty? The IRS keeps an eye out for large balances in retained earnings, cash, or loans to shareholders that are reported on your corporation's balance sheet. While the AET can be imposed on any C corporation, small, closely held corporations are particularly vulnerable since their shareholders are more likely to influence dividend policies. Now you might be thinking, I don't see this tax on my forms, so how bad could it be? Well, that's part of the problem. The AET is a hidden tax. It doesn't show up on your annual tax return. It's a penalty imposed after an IRS audit. Imagine this. You go about your business thinking everything is fine, and then bam, you're hit with a penalty that could have been avoided. Let's go over some strategies to avoid getting caught by the AET. First, consider electing S corporation status. S corporations don't retain earnings like C corporations do, so this can be a straightforward way to sidestep the AET altogether. But remember, this only applies to future earnings. Any excess earnings retained as a C corporation are still at risk. Next, focus on keeping your retained earnings under the AET threshold. For most C corporations, this means retaining no more than $250,000 in earnings. For personal service corporations, think accountants, lawyers, or consultants, the limit drops to $150,000. These amounts might seem low, and that's because they haven't been adjusted for inflation since 1981. If they were, those limits would be much higher today. If you need to reduce your retained earnings, there are several options. Paying out dividends is the most obvious one. Increasing salaries and bonuses for corporate employees is another, though it's crucial to ensure that these payments are reasonable. Otherwise, the IRS might recharacterize them as disguised dividends. Providing more employee fringe benefits, like qualified pension plans, can also help. Now, what if your business genuinely needs to retain more earnings? The IRS allows this if you can prove the retention is for reasonable business needs. But what qualifies as reasonable? It's a subjective judgment, but there are some common criteria. These include plans for business expansion, purchasing another business, paying off debt, or maintaining necessary working capital. To protect yourself, it's essential to document your reasons for accumulating earnings. This should be done contemporaneously. In other words, don't wait until after an audit to justify your decisions. Include these reasons in your corporate minutes, board resolutions, business plans, or budget documents. For example, if you're setting aside funds to purchase a new building, Keep records of your budgeting documents and any related communications. Here's the key takeaway. To avoid the AET, you need to be proactive. Document everything, stay within the retention limits, or make sure your retained earnings are justified by reasonable business needs. By doing this, you'll not only avoid the AET, but also keep your business on solid financial footing. Thank you for watching. If you found this video helpful, be sure to give it a thumbs up, share it with your network, and subscribe to our channel for more insights into navigating the complexities of business taxes. Have any questions or need further advice? Drop a comment below and we'll get back to you. Until next time, keep your business thriving and tax savvy.